But here's the 1050 to 1110 macro. And if you're a first time viewer and you don't know what that means, every single 60-minute interval, okay, every 60 minutes, every hour, okay, at the top of the hour, the market will spool. That means it jumps and runs to one of two things. It will go to a short-term low to tap into liquidity, that it would be sell stops or sell side liquidity, or it goes up to a short-term high, which is buy side liquidity, or engage buy stops for the purpose of introducing liquidity to the marketplace, or it trades to an inefficiency to invite smart money to capitalize on an entry right before price spools to the liquidity. So in case you missed it, the inefficiency I identified as it was forming, I said, I want to see this stay open, and I drew your attention to that volume imbalance on the daily chart. But it's occurring at 1052. It's trading in that inefficiency. For what reason? It's going down there to offer fair value for anyone that understands the elements that I'm teaching you. Then where does the market trade to? Liquidity, which is that high here, because when it drops down here, the highest high prior to that is here. But what's above that? What I took your attention to on the daily chart, that volume imbalance. So from this candle's low, which is 18,931 even, to this candle's high for the buy side, 5150. So we have 21 handles, or no, 20 handles. Okay, 20 handles. That's enough to do a trade for like a bread and butter type sec. I can eke 10 to 15 handles out of something like that. Can you? I don't know. But if you're not confident, don't do it. So to give a better range, that volume imbalance that's shaded in yellow that I got on the daily chart, the low of that, and we'll just ballpark it and say it right here, that's 56. So it's 15 handles. Consequent encroachment, eyeball it, 60. So we're looking at 30 handles thereabouts to get the halfway point, which is right up here. And that's exactly what I said. I would only expect that from Caleb. So being a buyer down here, should he have felt inclined to do so, and getting out at midpoint here, and maybe getting filled here eventually, that would be the trade. And then he'd have to move to the sidelines to be content with it. So at 1052, we're trading inside the time. That means every hour a macro is in operation. Every single hour. Okay? Some macros are better than others. I'll leave that for the book. But I've talked about most of them already on Twitter Spaces and or other videos on this YouTube channel. There are times where you want to be using them, and others you just want to sit and wait. That's not the right color. Okay, and this would be labeled on your chart 1050 to 1110 a.m. Eastern Time. Always Eastern Time. Inside, center. All right. And what we've done is we've highlighted a time when the algorithm that absolutely does exist, it controls price, and nothing happens outside of its control unless it's a manual intervention. And you'll know when an intervention is there because it's just completely abrupt, sudden, forceful. You're raped, basically. The market doesn't give you any chance of getting in. It just runs away, one-sided. And if you're in it and you're on the other side of the marketplace and you're offside, you're destroyed, basically. That's manual intervention. Okay, manual intervention is FOMC. Look at it like that. That's always going on. Every single time FOMC comes out at 2 o'clock and at 2:30, both of those things are manual intervention. They're absolutely controlled demolition. That is not organic. That's not buying and selling pressure. It's not an absence of buyers or sellers. It's not a void of liquidity. It's an unadulterated rape. That's exactly what it is. It's destruction. It's carnage. It's designed to do that. And the sooner you accept that, the better you'll be looking at it and trading after it forms. But at 10:50 for the hour at 11 o'clock, 10 minutes before 11, and 10 minutes after 11. That's a 20-minute interval. Okay? What occurs is the market will seek either inefficiency, like this gap here, or it will seek liquidity. If it's, like, say for instance, we didn't have this gap here. Okay? Say this wick touched this wick, or the bodies touched. There was no separation between, and not having this one singular candle traversing between the previous candle's high and the next candle's low. So there's no gap, basically what I'm saying. If that's the case, then what you would do is you would wait for the down close candle that forms in any retracement here. It has to run away from it and then come back down, like we're teaching this order block. That would be what you would look for. But if there's no inefficiency, you have to use the order block. So either it's a gap or an order block or a short-term low. So there is no short-term low in here until that forms. But what's there? The inefficiency. So there's no condition that has all three. You know what I'm saying? Like, you're not going to get a short-term low, an order block, and a fair value gap. That can't occupy the same space in the time frame or chart you're looking at. It's physically impossible. It doesn't work that way. So when students first start hearing these lessons, when I had paid mentorship, they would like, well, how do I know this? And what if it? Once you spend time looking at it, they can't all three agree and exist in the same place, not at the same price and same time. It doesn't work that way. It's two at best, but never all three. But usually it's one or the other. Okay, at least one of the three. So there's no short-term low to be worried about trading down below. We do have a gap, but it happens to form after a breakaway from all the consolidation that we were monitoring and I was not interested in all morning here. And I mentioned that we had these lows down here. We swept below that, and I said, okay, I believe that they're going to use the fair value gap that I mentioned here as support. They didn't really technically touch it at all. It was like one tick away, but it then displaced above the high. This gap forms after that breakaway from that consolidation, which is classic algorithmically. It's not classic support and resistance because it never came back down and touched that wick. So at 10:52, we have our first piece of information. Yes, price did trade down in there. Yes, it did not fill that lower portion. And any subsequent touch of the fair value gap high can be used as support. It should be immediate response, take off and leave it, and trade to that high. But how far above that high can it go? You got to go to a higher time frame reference point, which is why I took you to the daily chart to highlight this volume imbalance. It was the easiest, obvious level above this high that's inefficient, because there's no way you can classify short-term buy-side liquidity on the daily chart because you have to go further up. So what's the first PD array that you'd come to on the daily chart? It's this shaded area that I highlighted, which is the volume imbalance. So from entering here at 10:52 into this fair value gap, you have all the way up to 11:10 to see any new entry. So all through this period from here to here, relative to time, okay? This is a time window. In other words, this is what you're saying. In price action, there's going to be opportunities to be a buyer at a discount array. What discount arrays do you see? Institutional order flow entry drill inside this fair value gap that should not fill in because it's a breakaway gap. Why? Because it left the consolidation. Okay. Then we have this down close candle. Does it repel price after? It does. Does it trade above the opening price? Yes, that validates this down close candle as an order block. Is there any down close candles prior to that candle, immediately to the left of it? Yes. Is there one prior to that one? Yes. Is there one prior to that one? No. So algorithmically, the price is called to that opening price because it's the highest portion of these three consecutive down close candles, the opening. That's the price. That's the change in the state of delivery. You extend that through time. How far do you do it? All the way till 11:10. Pray fucking tell how the hell all of this stuff just happens to line up all by time first and price to the fucking tick. There's no algorithm, folks. There's no way they could control price like this. How could they possibly keep things this controlled? 81 million votes my fucking ass. But looking at this, if you extend it forward, trades right back down into that opening price. Bang. Then it delivers higher. If you're trying to get on board and you're trying to work with a macro, because a macro, that 20-minute interval is like a supercharger for efficiency and immediate responsiveness in your entries. That's not to mean that you can't take trades outside of this. So don't think for a moment that I'm trying to say ICT only teaches the trade in the first 10 minutes up to the last, for the first 10 minutes prior to a new hour and 10 minutes after the new hour. I'm not saying that that's the only entry times. I'm saying that as my son, if you focus on these elements of your setups, you're going to get the better fills. You're going to get the immediate response by price telling you, yes, you're on side. How do you know you're on side? When the market immediately starts moving away from your entry and never getting close to your stop. That's a wonderful feeling. How do you get into trades that promote that as a steady diet? Time. Time is the most critical function in price delivery. And if you can't see that, literally you're in denial. You're in fucking denial. At this stage in the game, after me showing so much, you can't see this, there's no hope for you. Just believe it's all random. And don't ever watch my videos. But the point is you have the down close candle here that we walk through the sequence of, okay, guidance tells me that if this is an order block, the way you determine is there's a down close candle prior to that one to the left. Yes. And it does it here. Yes. And then you don't have it here. So you use the opening price there. That's all their algorithm's doing. That's the code. That's what it does. By time, it does this. Okay, it touched here. Why? Why is that important? Because this is the framework that causes that inefficiency. This is where we traded to the low of. So to get this fill perfectly, it's got to offer one tick below it. And that's why it goes down there. That's not fucking buying pressure that stops it there, folks. It's not. The collective universe of buyers and sellers didn't say, hey, listen, today's my turn to be the buyer. I'm going to be low tick today. I'm low tick. Everybody else had a chance to do it, but it's my time. I'm going to be the buyer that gets the low tick on that candle. Think about the absurdity of stating that the buying and selling of everybody out there with all of the shit that they look at on their charts, the things that they believe. The last time their elbow hurt, NQ went up 50 handles. The last time they had gout, the NASDAQ dropped 500 handles. The nonsense. The people that fucking look at the stars and the moon and the lunar sequence and says, oh yeah, Jupiter's in retrograde and this is bullshit. That has nothing to do with these markets. It literally has nothing to do with it. But they'll write books and sell courses and people will buy that shit and eat it up. They'll eat it up and ask for more. They'll cheerlead these people on the internet and say, they're so smart. Look at the wisdom. Look at the sorcery. He can read the lunar cycles and it causes the fucking market is not giving two shits about what the fucking phase of the moon is or where the planets are. You're talking about horror scopes. Horror scopes. Okay, I mean that facetiously. I am not following the fucking sun, moon, and stars to pick a trade idea, okay? Because it has no bearing on it. Do full moons cause people to be more aggressive? Sure, I believe in that. But when I read that stuff in Larry Williams' book, How I Made $1 Million Trading Commodities last year, and he was talking about the effects of full moons and what all that, it was an interesting read, but I don't subscribe to it. I don't believe any of that bullshit. Fascinating read at that time, but I hold absolutely no interest in it. And I don't believe absolutely at all that has no bearing whatsoever on what price is going to do. So when we look at price like this, okay, every hour you should have an alarm or you have vertical line. Now, when I say the vertical line delineations, this might be problematic, okay? Because if I do that, you may not see the colors of your wick where the high and low is. So just be mindful about what I'm about to say here, because if you're not going to set alarms time-wise, like on a clock, say, hey, look, we're 5 minutes away from the next macro. What time would that be on your clock? It would be 10:45 a.m. Eastern time. That means New York local time. Everything I'm saying, folks, if you don't have this on TradingView toggled, I don't care where you live. Your time should be set to this all the time. All the time. Doesn't matter where you are geographically around the world. This is the time that the algorithm runs on. Period. But if you don't want to use time alarms, okay, you can set up little vertical lines framing the macro at each top of the hour. Okay, so it tells you, okay, start looking for a run to gaps or inefficiencies, or trade to liquidity. Which one do you do? Well, right here at 10:50, that's the beginning of the macro. So what occurred right there at 10:50? We've already taken out relative equal highs. So we are engaging liquidity. What kind of liquidity? Buy side. So what is the more likelihood of price going higher at that moment or going lower? Well, we have the short-term low that it forms and then trades higher once more. So we have buy side once more. The inefficiency below the marketplace is where? It doesn't exist in here. All this run up to that high, there's no gap there. All of it's laying over top of each other. This wick here goes back to this low. So there's no inefficiency there for the 1 minute chart. So what does it mean? Sell side if it's going to go discount to here, and or what's that daily inefficiency that's in yellow? That volume imbalance. We went down to it here, we rallied back up, traded down, one more higher high, and then digs all the way back down. What time? 12 o'clock. So that's mid macro. It's like the first 10 minutes entering the last half an hour, or last half of that 20-minute period. So if it's going to be reacting off of that, and if price is bullish, where would it go to at that moment? The price will spool where? To a inefficiency above that. So where's that at? Not here. It's basically overlapping there. You have this one, which is a volume imbalance, which is a smaller form of what this shaded area is that's derived from the daily chart. So you can trade up to that. It does that handsomely. It does this one here again handsomely. And you have all of this here. It trades up to that there. And then you have the liquidity above that high. So it's just like riding or climbing a mountain or rock climbing. This is the surface of the mountain. You just drop down to go into an area, then start going back up. So you have to look at that surface of that rock like a rock climber and say, okay, where's my footholds? Here, all of this inefficiency. How can this inefficiency be used as a foothold? It has to go above it and then come back down in here and then sends price higher again, taking out this high. So price is doing what? It's using this time to refer to key price points. And if you are looking for a directional run, it helps you frame that. Every single hour it does this, which is why I used to brag about it all the time on Twitter. I'd say, look, I can trade every hour candlestick. Every single hour I can trade it. And it's based on this idea here. Okay? All the stuff about 90-minute cycles, I'm telling you for the last time, there is no 90-minute cycles that you can go out and copy and do something with. There's people doing all kinds of bullshit, talking nonsense about it. It's just a measure of, like, that's the smallest window of your trading time. Anything less than 90 minutes, you're not giving yourself a fair chance. Because what that does is it guarantees you're going to get one macro. Very minimum, you're going to get one macro. And if you're knowing what the price is likely to do, because you understand how to read price, and you also understand a directional draw on where the market may send price. That means, what do you think the daily candlestick's going to do? What do you think the session's going to do? What is the weekly chart reaching for? These are all things that we taught in previous mentorships that are being rung back in here because we spend enough time on the lower time frames, proving that you don't need to see all the other stuff, but to get a better view holistically incorporating the higher time frames, weekly and daily, you get much more information, which makes your trade decisions a lot easier and better. So you can see how these elements of time, they're crucial. They are superchargers for anticipating price runs and how they are to behave, how they function. What's the mechanics behind why a price run takes place? That was what I did a lot of study in my 20s. I wanted to know what repeating phenomenon were there in all of these price runs. And back then, I would be in trades where the market would just take off and start trading one-sidedness, and I would go back through and looking for patterns from the book Technical Analysis on the Financial Markets by John Murphy, and I couldn't see anything in there because he was teaching support and resistance. So why was these prices going down to specific levels that were completely by themselves? They had no rhyme or reason to why it did it. And I collected and I collected and I collected, and I started seeing these repeating phenomenon. And I was obsessive about reading price, studying. I wanted to figure this shit out. I had to know. It was a physical problem for me. It was consuming every aspect of my life. And you can hear it. I mean, I'm here. It's 20 minutes after 12. I was supposed to be out of here 2 hours ago. But this is my life. This is my passion. And it's my baby. So I want to brag on it because she does exactly what she's told to do.